This is Lee Amity from TradeNet. Welcome to our lesson on long and short. Long and short are terms we use regularly in trading and represent the direction we invest our money in the markets. Therefore, when we are going long, we are talking about buying before we sell, and therefore we profit in a rising market. When we talk about going short, we are talking about selling before we buy, and therefore we profit in a falling market. Let's look at some examples. When we go long, we make money from a rising market. Or in other words, we buy a stock cheap and we sell it expensive. Going long is the most conventional way of making money in the markets. When we go short, we make money from a falling market. Or in other words, we sell a stock expensive and we buy it back cheap. We profit the difference. Let me explain this concept in a different way. Going short is much like buying a large piece of furniture. Let's say a sofa. Often, when you buy a sofa, you don't take it away from the store after you pay for it. In this instance, let's say the sofa cost you £2,000. The company that you bought it off then gives you a delivery date of when the sofa will be delivered. Now what does the company do? They buy the sofa from the manufacturer, of course. Now what do they pay for the sofa? Let's say they pay £1,000. What has the company done? They have just gone short the sofa. They sold it to you for £2,000, then they went and purchased it cheaper from the manufacturer for £1,000. You get your sofa, and the company gets a cool £1,000 for their efforts. One of the advantages we have as private investors is we can make money in rising markets and in falling markets. When we are buying cheap and aim to sell expensive, this is known as going long. When we are selling expensive and aim to buy the shares back cheap, this is known as going short. This concludes our lesson on long and short.